The Keltner channel is a volatility-based indicator used to identify potential overbought or oversold conditions and to spot potential trend reversals. Here's a detailed explanation of how it works and how it can be used in trading. The Keltner channel consists of 3 lines. The middle line is an exponential moving average of the price, typically set to 20 periods. The upper band is the middle line plus a multiple of the average true range. The lower band is the middle line minus a multiple of the average true range. The upper and lower bands are typically set 2 times the average true range above and below the exponential moving average, although the multiplier can be adjusted based on personal preference. The Keltner channel helps traders identify the direction of the trend. When the price is consistently above the upper band, it suggests a bullish trend, while consistently below the lower band suggests a bearish trend. When the price touches or crosses the upper band, it may indicate that the security is overbought and could be due for a pullback. Conversely, when the price touches or crosses the lower band, it may indicate that the security is oversold and could be due for a bounce. A breakout above the upper band or below the lower band can signal the start of a new trend. However, it is essential to confirm the breakout with other indicators or analysis. The upper and lower bands can act as dynamic support and resistance levels. The price often oscillates between these bands, and significant breaks can indicate potential trend reversals. Imagine you're analyzing a stock that has been trading within a range. If the price touches the upper band and then breaks above it with significant volume, it suggests strong buying interest and a potential continuation of the uptrend. Conversely, if the price touches the lower band and then breaks below it with significant volume, it suggests strong selling interest and a potential continuation of the downtrend.